Good morning, everyone. My name is Richard Green. I'm director of the USC Lusk Center for Real Estate. And as always, it's my pleasure to welcome you to this edition of Lusk Perspectives. This is a program we started in March, immediately after the shutdown. I believe we are on edition number 25 today, so welcome. It's my great pleasure to welcome Bonnie Wongtrakool to Lusk Perspectives today. A little background, a number of you have said to me that you are very interested in the issue of ESG. And in particular, you want to know what it is. And it's becoming increasingly important because increasingly there are investors who are not willing to invest in companies, entities, et cetera, that don't have ESG plans in place. So it turns out, by a happy coincidence, my neighbor, Bonnie, runs ESG for Western Asset Management, a company I'm sure many of you are familiar with. It's well known as a structured finance investor. And she does ESG for them. And so I thought, let's have somebody who runs ESG for a really important company come and tell us what it's all about and then have a conversation around that. Before I introduce Bonnie a little more formally, I do want to share with you a little story about Bonnie and her husband, Byung Kim, who, as I said, are my neighbors, who started a series of concerts on Sunday afternoon. And very soon after, again, we got locked in. You can hear them well from my front porch, about a block and a half away from their house. We often wandered over to listen to them. And what I will tell you is they are really good players, both of them, and they get really amazing guests to come and join them from time to time. They have not done it for the last few weeks, but it really made living in our neighborhood a much more pleasant place, which tells you, at least when it comes to the S part of ESG, which is social, Bonnie puts her money where her mouth is, does things that actually makes the world around her a more pleasant, better place, particularly in times of difficulty. Bonnie has a distinguished resume, graduate of Harvard Law School. She's been with Western for about 17 years now and has been running the ESG program for 2 years there. Bonnie, welcome to Lusk Perspectives. Thank you very much for being with us today.
Thank you, Richard. Appreciate the invitation, and it's great to be here. So just again, in case some of you don't know what Western Asset is, we are a fixed income global money manager. We have about 470 billion in assets, and it does run across all different fixed income classes, including mortgages and asset-backed securities, but also sovereigns, corporates, high yield, bank loans, investment grade, you name it, absolute return as well. So that's our background. We are headquartered here in Pasadena, but we also have 8 offices around the world. So Richard asked me to give a bit of basics of ESG here. So in order to do that, I'm going to share my screen and walk you through a few slides that will hopefully help you understand what is ESG. So I think everyone understands what the E and the S and the G stand for: environmental, social, and governance. But what are people actually looking at when they talk about ESG? So this slide here has a number of different examples of E, S, and G factors, many of which, if not all of which, are relevant to the real estate sector. And I'll walk you through some of those so you can get a sense of what people look at. So under environmental, there are a number of things that pertain to just the development phase. So when we're talking about what type of materials are being used, are they sustainable, what type of energy efficiency in the property, that's one of the things you'd look at, as well as during the construction, is there a disturbance to the surrounding community, to biodiversity, is there deforestation, that type of thing. And then there are other things that are relevant along the entire operation of the property. So that does include the greenhouse emissions, which in part depend on how the building has been constructed. But also, and I'm sure you've all seen headlines about this, the property's resilience to things like natural disasters like floods and hurricanes. Where is it located? Is that area going to be very vulnerable to climate change? So those are some environmental factors. Under social, there's some things that pertain to all companies and are fairly obvious. How are you attracting your employees? How are you retaining them? Do you have a diversity of skills and of viewpoints within your organization? And then there are others that are less well-known. So, for example, are you employing labor that is illegal? And a lot of employers might not directly be doing that, but they may have it in their supply chains. And we're seeing increasing scrutiny around that, especially in sectors like apparel. So right now there's a lot of focus on whether some of the apparel retailers are using manufacturing that does employ ethnic Chinese labor, for example. But for going back to real estate, there's also things like how are you managing your relationship with the community? And that could be very pertinent both in the development phase, but also in the operational phase. And then finally, under governance, we're really trying to look here at what is the quality of management and how are they approaching risk? How are they managing it? And it's really important to have good governance because without the good governance, you really can't manage the environmental or the social part of ESG. So it's extremely essential. We consider this to be the foundation at Western Asset when we're looking at ESG. But they are things that you would think about, like how is compensation, is that aligning the management with the long-term goals of the stakeholders, or is it about short-termism? Is there transparency around how they're reporting both their accounting and also how they're doing their taxes? And if there isn't, that often can be a red flag for problems elsewhere in the organization. And then there are elements that are pretty hard to analyze, but that can be extremely important, such as around bribery and corruption, and those can be hidden for many years and then come out and be quite detrimental to that organization and possibly be the death knell of it. But when we're looking at governance, we're looking at how is the company managing against the risk of all of those things and hopefully trying to minimize that. So why would we look at any of these things, E, S, and G? And it's really because we're looking for factors that can influence the long-term sustainability of an organization. Even if they're not financial and not on the SEC filings, they still might be quite material. And that is the purpose of looking at ESG within analysis. So if that's ESG analysis, I'm trying to turn to my next page here, which is not quite working. Oh, there we go. What is ESG investing? Because that's a different kind of question as well. So there's a lot of different ways to implement ESG within portfolio management. And I would divide that into two basic groups. So on the left-hand side, you have ESG integration. And what that refers to is that you're looking at ESG factors among many factors in your investment analysis. So you're looking at the financial factors and you're looking at non-financial factors and you're considering them holistically. And that's how at Western Asset, that's what we do. We do this throughout all of our portfolios because we really do believe in order to assess fundamental value versus market valuations, you need to look at all those different things. On the right-hand side is a thematic approach to ESG. And this is where specific ESG factors are driving investment decisions and security selection within the portfolio. So there are two ways to implement thematic ESG investing. There's a negative screening and there's a positive screening. So the negative screening is well known. It's called SRI often, socially responsible investing. And this technique has been employed for decades. And what that refers to is the exclusion of certain types of business activities from your portfolio, or maybe even countries that are sanctioned perhaps. But common SRI filters today would be tobacco or weapons. And now we're seeing an increasing number of discussions around fossil fuels. And so at the university level, a lot of universities have been debating whether or not to divest their fossil fuel investments. On the right-hand side is the positive screening. And this is a newer type of field, I would say, in the sense that it used to be more niche. There used to be sort of a impact investing community, but it was very limited and perhaps just limited to some high net worth or family offices. And now it's become a lot more mainstream. And essentially how this is expressed is sometimes it's a best-in-class approach. So the portfolio is looking for issuers in sectors that are best in class in their ESG practices, or it can be something more thematic, like a clean energy fund or a gender equality fund. Or it can be in the fixed income space, it can be something like green bonds and social bonds, which are fixed income instruments where the use of proceeds is dedicated towards a green project or a social project. And I'll talk a little bit more about that in a few minutes. So when we look at ESG investing, how big is it really? And this study comes from the GSIA, which is the Global Sustainable Investment Alliance, from 2018. So that's the most recent figure we have, and it has certainly grown since then. But it does give you a sense of how big and how each of the techniques that I just described are employed. So these bars on the left-hand side don't exactly line up with the categories I said, but pretty close. So the largest bar there, the one that's about 20 trillion, that is the SRI category, which, as I said, has been used for a long time, and I think will continue to be used, and it continues to grow. So globally, it's growing at about 15%, and I expect that to continue. And then the next biggest bar is the ESG integration, which was the left-hand side of the previous chart that I showed, where you're looking at ESG among many factors, and that's growing a little more quickly. It's growing at 29%. And that's the technique that's being employed by a lot of large asset managers. If you look to see the largest global asset owners, over half of them say that they're using ESG integration right now. So it's become increasingly common. And then from the right on, the third, fourth, fifth, sixth, seventh bars, they all refer to basically thematic approaches. Most of them are positive screening, although the norms-based screening is more of a negative screening. But some of these positive approaches are the most quickly growing. So you can see sustainability themed investing, that would refer to best in class, or like the clean energy fund or the green bond fund. That's growing at 92% globally. And much.
Oh, excuse me, Bonnie, just a clarification. 30 trillion?
That's right.
So the entire US mortgage market is 10 trillion. So you're talking about 3 times the size of the US mortgage market.
Correct. Although, Of course, the 10 trillion refers to securitization, right? So if we included other things, then...
Well, no, residential mortgage total, so securitized is like 7.5 trillion. It's total a little over 10. I just looked at the number this morning.
Oh, okay. Yeah, so
it's an astonishing number. I just wanted to underline that, so...
Very true. Yes, it is. It's big and definitely growing. And I think that's why people talk about it more and more. And why has it been growing? So there are really 3 factors that have driven the growth. And I referred to how a lot of the global asset managers, are the large ones at least, are using this, whether they're on the institutional side or elsewhere. And that's because it's considered material. And so when I was talking about the ESG factors on the first page, those are all selected because they're material to the performance of the company. And those factors can vary depending on the industry that the company is operating in or the specific company itself. But the fact is, they're looked at not because of some charitable function, but because they have pertinence to the performance of the company. And this belief that there's materiality of ESG factors has become fairly well accepted. And that has been the biggest driver of growth in ESG. The second factor is really client demand. And there's 2 ways to look at that angle, I'd say. One is that there is an increasing number of retail investors who do want to have investments that resonate with their values. And you've probably all seen these headlines about millennials and how they want to have sustainable portfolios. But I think that there are other generations too that are interested in this. But also for more mainstream investors, some of them do debate this whole short-termism of management versus long-term sustainability of their investments. And they just want to understand, are they really investing in companies that have an eye towards long-term sustainability and not just towards padding the executives' pocketbooks, for short-term gains. And then the third factor that's driven growth is really regulation. And many of you may be thinking, since we all live or probably most people listening to this live in the United States, what regulation? Because there isn't any regulation in the United States that's supportive, and in fact, it's probably going the other way, especially if anyone has been following the Department of Labor and their proposed rule around ESG that was just released a couple of months ago. But I think it's helpful to look elsewhere outside of the US, especially at Europe as a model. So Europe, after they signed, the European Union, I should say, after they signed the Paris Agreement, they basically started putting into place different plans to be able to meet those goals. And part of this was planning for this new low carbon economy, which obviously requires financing. Last December, they also announced a new Green Deal, and that's $1 trillion in investment that is, again, trying to help them push towards the Paris Agreement, but also become carbon neutral by 2050. And this plan is very comprehensive. It does things like lay out a taxonomy for what types of businesses are environmentally sustainable. It also sets out a green bond standard that's even more stringent than what's currently being used in the market. But importantly, it actually requires investors basically to explain why they're not using ESG if they're not using it, rather than the opposite in the US, which is explain to us why you're using ESG if you want to use this in people's 401ks. So this phenomenon in Europe has been going on for a while, and the regulation actually, I would say, came after the investor desire to do it. But it has definitely helped to bring along those countries or those people who weren't bought into the idea of materiality previous to that. And we'll see that, I think, continue to spread. I think Australia will be very similar. I'm not holding my breath for the US, but I think when everything outside of the US starts moving that way, you really do see this growth that we saw in the last slide. Now, I talked on the first slide about green bonds and social bonds, but I wanted to give you a sense of the growth in the market. And again, those green bonds are the ones where the use of proceeds has to be used for something that is green. So it might be an energy efficiency project or renewable energy, or it could also be something else relating to the environment like water usage and having clean water. The social bonds are ones for social purposes. They could be financing education, it could be affordable housing, things of that nature. And then there's a third category that's even more recent, which is sustainable bonds. And those have a combination of environmental and social use of proceeds. So you can see it's been growing over the past 5 years. So that 2020 is obviously year to date. And during the crisis, when the market really tanked, the markets froze up and the non-ESG part of the bond market came back faster. So there's a little bit of a lag there. But I think what to note is that it has been growing over time. Now what is outstanding is over $1 trillion. And probably the most interesting trend is that the social bond component, which was fairly small and muted before, this year has grown quite a bit because there is this interest in and need for social financing given the problems and challenges posed by COVID. And then the right-hand side of the chart essentially shows where the issuers issuing these bonds come from. Most of them are actually European, and the US is a fairly flat kind of percentage contribution. But it has picked up, especially this year. I think that will also continue. And we have seen quite a few REITs, I'd say, in the smaller US bond market have issued green bonds. And I think it's been helpful for them because it has increased their investor base. So they've been able to reach certain investors that probably wouldn't have looked at REIT bonds before and have actually traded better. So it does help their cost of capital. And I think other sectors are also catching on to that. And so you see a little more diversification in the types of issuers that are issuing green bonds currently, although not so much in the social bonds. Those tend to be more from financial institutions. And then I just wanted to close up with the slide segment at least, just talking a little bit about Fannie Mae, which has actually been a very active participant in the green bond market. So they actually started issuing green bonds in 2010. Now they've done over 75 billion. And at one point they were the largest US green bond issuer. That was in 2017 when they issued 2/3 of the green bonds. Then it was a smaller market, of course, but they have been quite a pioneer in that. This year they've been pretty quiet, although I would note also that they've started to do a separate program for single family residential mortgage-backed securities. So they've issued a handful of these bonds that are, the collateral is basically a single family housing that is Energy Star or better in terms of their certification. And I think they're trying to tap that part of the market, again, trying to diversify their investor base, and we'll see how that takes off. But But Fannie Mae has been kind of pioneer in this green bond market here, and it's a good asset class. Although it does trade, unlike the REITs, it trades pretty much non-green CMBS. So those were the slides I wanted to share, and I'm just going to stop sharing my screen and back to you, Richard.
Okay, thank you. Well, I have a bunch of questions, and I see we have two from the audience that I'll get to in a moment. And again, please, anyone in the audience, if you have a question of Bonnie, type it into the Q&A box, and I will get to it. The first question, you talk about millennials' desire to invest in companies that they're comfortable investing in. But you use the phrase retail investor, and that sort of made me think of the following, is most retail investors don't invest in individual stocks. They're investing in Vanguard funds. Is the mutual fund industry developing green mutual funds, and what do they look like, if so?
Yes, the answer is yes, they definitely have. It's come a lot in the ETF form. So there are a lot of ETFs that are basically indexed to ESG indices. And typically these ESG indices are based on third-party ratings. So the biggest third-party raters are MSCI and Sustainalytics, but MSCI is the one that owns an index business already, so you can guess who has these indices. And basically the S&P has an S&P ESG version, and there can be an ETF that holds those stocks that are rated highly by MSCI. That's a very common form of it. But there are also ETFs that do some of those things like clean energy that I mentioned. I've seen gender funds now. And all of those funds have grown a lot this year, again, off low basis, but it has been notable that those funds have grown and gotten inflows this year faster. I'd say their growth is faster than the non-ESG funds, retail-wise.
So you mentioned that, so I want to ask a couple of Fannie questions. One is you mentioned that the green Fannie bonds trade on top of their non-green bonds. Do you think that there was a liquidity issue with them, and that if there were just more volume, they might actually trade at a small premium relative to?
Yeah, that's a good question. I almost feel like it's maybe the opposite in a sense, because there isn't scarcity value. And so it's not, I would say that the issuances don't come that often, but you can get one, so that there's that. I think there's less scarcity value than there would be in other corporate issues where, say, for example, Google just issued a green bond 2 weeks ago, and that was very highly sought after. I mean, it was their first green bond, first of all, and they have scarcity in general. They don't actually issue much in the market. But I think that there's a little balance between, you want to have liquidity, but you also want to make it somewhat different.
Well, so since you think hard about sort of the underwriting of fixed income securities, do you think that green bonds should trade, all else being equal, should trade at a premium vis-a-vis other bonds?
I think fundamentally speaking, I would say that the fundamentals should be pretty similar to a non-green bond. I guess, let me take a step back, Richard. So should they trade at a premium versus non-green from the same issuer, or should they trade at a premium versus an issuer in the same industry?
No. I mean, so you have the same issuer, and let's say they're doing commercial real estate, and some of their buildings are Energy Star, LEED, et cetera, and other buildings aren't. And that's the only difference between the two.
Right.
Would you expect a difference in the coupon on those two bonds, or would you expect them to be the same?
Right. At the end of the day, you want the credit itself, regardless of whether it's doing green or not green bond issuance, you want it to be very solid, right? So theoretically, I guess fundamentally, you would want them to have the same value. But I think because there is that demand from a different investor base, a broader investor base with a focus on that greenness, it does tend to trade a little bit better. I mean, there are obviously exceptions to all this, but that has been the pattern. And I don't think that's unjustified, frankly. I would say this is maybe a little bit on the liquidity point, but to the extent that an issuer has both green and non-green bonds, if there is a market downturn or some type of outflows, the non-green bonds are more likely to be sold to raise cash to meet outflows than the green bonds would. So in that sense, perhaps you could assign a tighter spread for that reason alone.
I see. I mean, one thing is, there's been some really good work done by a couple of guys at Maastricht named Pete Eicholtz and Niels Koch that find that the performance of the buildings, the financial performance of buildings with green features is better. And what they can't differentiate is it the greenness that makes them better, or is there an association between greenness and quality that makes them better? And it's nearly impossible to disentangle the two because bad buildings don't get green treatments. But in the sense it doesn't matter, it's still, from an investor standpoint, it would still be a signal. And you do see these buildings like trade at a premium relative to those that don't have these features. And so that would suggest to me that they're just a safer thing to invest in, whether you're on the equity side or the debt side.
Right.
Properties.
I agree with your signaling thesis because it does indicate that the company is forward-looking, especially when you're talking about real estate, right? Because it doesn't necessarily pay off immediately if a company is, a building is retrofitted or something like that, or if it has top-of-the-line sustainability materials, but it indicates that this issuer is thinking about those considerations and the fact that later on, those types of things do matter, either later on or currently, they actually do matter. So there is a signaling going on that could demand a premium as well.
So I want to take you back to Fannie Mae. And I'm wondering what you guys think about, and Freddie Mac and Ginnie Mae, the fact that the cost of credit in Houston and Cape Coral for homeowners is the same as it is in Ames, Iowa. That there really is no differentiation in the pricing of loans, depending on the vulnerability of the location of the houses. Or do you think about that much, and what are your thoughts?
Yeah, I do think about that, and I think about how that cost potentially in the future could be passed on to taxpayers. I think there has been a number of articles and commentaries written on that. I think that the institutional investor base that buys the mortgage-backed securities that hold that type of collateral, I think that now has become a lot more informed, and I think that the pools themselves are either fairly diversified where you wouldn't be experiencing that type of risk should it materialize. So there's a bit of, I guess, efficiency from that standpoint, but when you trace it all the way back to the taxpayer, unless we do see privatization, then I think it is quite relevant.
Well, I would even think from a standpoint of an investor, you're worried about prepayment risk. And so if Houston gets blown down, I mean, if the guarantee is behind you, you don't lose on the credit, but maybe the money's coming back to you at a time when you really don't want it to come back to you. And that creates, mismatch issues if you're, say, a pension fund or an insurance company, and you're thinking about your obligations in the future.
Yeah, that's definitely true. But again, I think the diversification, that's where it sort of comes in, and you're not going to see as many of these 100% Florida pools the way you did 10 years ago. I actually haven't checked because I haven't looked at a prepayment model in a couple of years, but I would guess that there's probably not any more 100% Florida pools being produced anymore. Maybe I'm wrong.
Okay. And well, my guess is you're right. And the other thing, I mean, there's a long debate about mortgage-backed securities about whether they should be transparent or not. And the idea is if they're not transparent, they're more liquid, because if they're more homogeneous in a sense, you're just counting on, and that's how the TBA market works anyway, right? You're just stuffing stuff in as it comes through the pipeline. But at the end of the day, there is still sort of and maybe it's a small impact, but it does seem to me that there's sort of a cross subsidy from some parts of the country to the others as a result. And this is beyond a bailout. There are places that maybe should have slightly cheaper credit than they do, and others that should be more expensive, just as a way of discouraging people from developing in areas that are more vulnerable.
Right. Although one would assume that at the lender level that the banks have gotten wise to this long ago, and definitely the insurance companies too, right? So you're seeing it priced properly by other entities, just perhaps not the GSEs.
Well, so it's funny. There's my colleague Matt Kahn did a paper on this, and it turns out there's a big time lemons problem, which is what banks are doing is the stuff that is more dangerous, if they're in these markets, the stuff in the floodplain, basically they're securitizing, they're selling to Fannie and Freddie, and the other stuff they're keeping on their balance sheet, which is,
Yeah.
Let me turn to a few audience questions here. So first of all, a provocative question from Joel Bryant. Under the heading of social, has Western Asset recalibrated or restated their investment policies as the result of the George Floyd killing and overall issues of racism in the US? Perhaps this would be kind of hard to draw a circle around and isolate, I get that, but just curious as to your thoughts about how has George Floyd changed how you're thinking about things, if at all?
Right. It's been a terrible series of events, right? That's finally culminated in the attention this year. So I think it's long overdue. And it is an issue that investors of all kinds are really taking a look at. But I think the difficulty in trying to help with that, although certainly you can help at the corporate level, it's more difficult to do on the investment level because we lack the disclosure to really examine companies on that issue, to be honest with you. So let me just draw a parallel, which is around gender. So previous to this year, I'd say a lot of the focus of investors was around gender equality as opposed to racial inequality. And this was many years in the making too. And it took a lot of years, I think, for us to get more focus on the female versus male representation in managerial roles and development within company management. But there has been some progress, but it took a lot of time. Having said that, there are a couple things that happened to help that. There were some regulations, and then there were more disclosures, right? So not all companies even disclose about females on the board or females in management, but some of them do, many of them do, certainly the large ones do. And that allows investors to examine where companies are, where they've been, talk to them about where they're going. In contrast, if you look at racial diversity and equality, there's really not a lot out there when we're talking about companies, as opposed to other types of data that we can get on the economy. But company management and how they're actually managing their employees, there's not a ton of disclosure. Some companies do disclose about minorities in management, but most of them don't. So that's data that we're looking at that we would like to have. So we can see who does report on and who doesn't. I will say most of them don't. And in order to even start the conversation as an investor, that's where you really need to be. And I think there's a lot of progress that needs to be made first. And I hope that it does happen, but I would expect it will take some time, just like it did on the gender issue, which itself is not neatly solved either. But very,
like
very
you need to
important.
hire young people who have sharp eyes to just go through financial reporting, see who the executives are, find pictures of them online, and try to get at least some sense of this. My guess is I have a strong prior about the share of executives in large companies that are not non-Hispanic whites, but it would be worth taking a look.
Yes, it would definitely have to be manually done is the point. And that would only get you the top tier of management. It wouldn't get you middle management. And we know from all the studies done on gender, and I know there'll be an increasing number on racial as well now, that a lot of the problem is about the pipeline, right? So you can have a regulation like in California that mandates you need to have one female member of the board if you're incorporated in California, but that doesn't really solve the problem. It's helpful, but it doesn't solve the problem of who's inside the company and who's being developed, who can become a leader within the company. And you need to start lower than just the board or just the C-level or who's on the website. And so these are difficult problems that are going to take a lot of work, but we definitely need to address them.
Yeah, the thing is, there's becoming increasing evidence on the gender side that women are really better leaders than men are. I mean, if you look at like funds that are managed by women, they do better. Now, there's a little bit of an issue of selection there. Is to be a woman who gets that role, you have to be so much better than a man that, of course, your returns are going to be better, for example. So if you could somehow randomized so you could have as many incompetent women as incompetent men in various positions, then you could really get at whether, I'm not sure I believe that women are inherently better at running things than men, but it is much harder for them to get the same roles. And I'm reasonably sure that that's true of African Americans as well. There was a really interesting piece in Bloomberg about a month ago on Black leadership of the Federal Reserve System. To this point, there have been 4 Black leaders, 3 who have served on the Board of Governors, and 1 who is the current president of the Atlanta Fed, Raphael Bostic. And of course, we're very proud of Raphael here because he was on our faculty for some years. Well, you read the qualifications of every Black member of the Federal Reserve System, Black leader of the Federal Reserve System, compared to their white counterparts. It's just an entirely different level of qualification. And so to the point, are they great at their job? Yeah, because they had to be just better to get there.
Right. It's very notable. I've seen the same, and I would argue that for a Black woman, it's even harder for a woman of color. So, and I know the Federal Reserve is starting to focus on this now, and I think that's very good. You know, we need all parts of the economy to focus on this. But, you know, to the original question of this attendee, you know, the company's a very good place to start, and we're just started to scratch the surface on that.
So let me remind the audience, for questions, please type in the Q&A box. Our next question comes from Lamont Gibson. And I think you sort of answered this, but I'm going to pitch it to you anyway. How does ESG policy affect taxation in enterprise? And maybe a way to put it is, are there any tax benefits or tax arbitrages available if you're doing ESG?
Oh, I wasn't sure what the question meant, but are there tax?
Well, that's my interpretation of it. And I hope, Lamont, I got it right.
There probably are. I mean, I'm not totally well versed on this, but I would guess that, you know, there are tax incentives for affordable housing. I mean, I think this audience will probably have varied opinions on the opportunity zone regulation, but, you know, there are certainly those things out there to support certain social goals. And we have also seen in the past subsidies for solar panels, and those have come and gone, and then same thing for EVs. So it's woven in there. And I actually think that that's probably necessary for certain practices that probably wouldn't happen as quickly as they need them to be if just left to the market. So if we talk about solar installation or electric vehicles, you know, those are things that probably need a little help from taxation, whether it's tax credits or other types of incentives. And those can be helpful, I think, tools for policymakers to try and advance some of these practices that probably wouldn't be taken up independently as quickly as we need them to be.
So can I come back to you in your role at Western Asset and ask a little bit? So you did a wonderful job describing what ESG is, and it was very clear and straightforward, and I think our audience really appreciates that. But from the standpoint of WA's decision-making process, where do you enter into it? How do you enter, without giving away trade secrets, of course, but how do you enter into that process?
Right. So the way that ESG enters our investment process is really at a few various phases. So when we're looking at a portfolio from the beginning, it's about the client and what they want, right? So remember when I was talking about SRI, those are client dictated, right? The client is going to say, I don't want tobacco, or I don't want to invest in, you know, fossil fuels, or whatever the case may be. And we're not going to form any judgments of our own. We simply implement what that client wants there. Or the client may want something that's very ESG focused, and they want to avoid or have special scrutiny on something like forced labor. And so we want to address that very well within their portfolio and provide them with analysis and research that supports that when we're looking at different credits for them. But I'd say both of those, again, refer to more of the thematic approach. When we're talking about just general integration, where ESG would enter is really at the sector and the issuer level. So there's sectoral considerations that are ESG related, whether it's energy or autos, or every sector has something, but some have more than others, where as a sector itself, that is influencing your view on that sector and your outlook for that sector. And then you go down another level and you look at the issuers within all the sectors and their practices and their risks. You know, again, often it's a governance related matter because that is very important for bondholders, but it can be other things too. And there's a dialogue that goes on between the research team and the portfolio managers where we are talking about these issues and discussing them and debating them. So there's some people who are focused on ESG and others who are generalists, and there definitely needs to be that dialogue going on. So for example, we were just recently talking about a mining company and their involvement in thermal coal. And so there's a debate about that because we had some somewhat conflicting numbers about their involvement in thermal coal. So there's a dialogue between myself and another ESG specialist and then the sector specialist where we were trying to ascertain the risk of that issuer to ongoing thermal coal involvement. So it's a very collaborative effort where we are looking at it, I'd say mainly at the sector and issuer level, but it is something that feeds into the portfolio no matter what type of mandate that it is.
So we've talked a lot about the E and the S, but not that much about the G yet. So on governance, what are some flags that you look for where you say that there's really something to worry about here in terms of how the company is governed?
Right. Some obvious ones would be around the access to management. So, we're not a small firm. We have 470 billion. And we do have good relationships with management. But if we see that management is pulling back on their communications with us or not being responsive to certain questions, no matter what the question is really about, that is definitely a red flag. Or if they're changing the frequency of their reporting, so they're giving information less frequently than they were before, that's definitely a red flag too. And then one can't understate just the human element of it. I mean, it's going to sound kind of strange and loosey-goosey, but being able to talk face-to-face with management about something that was on paper, but having them actually say it and asking them questions about it, whether it's their plans to deleverage or whether it's something that is specifically ESG related, there's a fair amount of assessment that goes on there too, that I think that there is an advantage to being able to speak face-to-face with an issuer about any type of issue to gauge really their credibility and their experience. So it's a bit of a soft topic, I would say in many ways, governance, but it's essential for sure.
What about, financial reporting? Are you just comfortable with GAAP standards as being sufficient to make judgments about governance, or do you want more?
Well, I think there's a fair amount of non-GAAP reporting going on too, right, these days. So we could talk a bunch about that, but do we want more? I mean, there's always more, right, that one could ask for from a company and how they do things. And so that's where it really does come down to the conversation about certain things that look like they've changed in a direction that you didn't anticipate or by a magnitude you didn't anticipate. That's the analyst's role to kind of dig into that and see, okay, is this really reflecting the true health of the company and their real path forward, or is this obscuring some other risk that we wouldn't otherwise see if we just looked at the numbers?
So I assume you, Western Asset, invested commercial mortgage-backed securities, and there are a couple of guys down in Texas who just did a really terrific paper that was released a couple of days ago on the overstatement of NOI in the CMBS offerings. So you look at what is the NOI the previous year before a refinance? What is it the following year? And in a very large share of cases, they claim it's going to go up by 10%. Well, if you have leases in place and so on, it's sort of hard to imagine that. And so what they did is they actually looked, and the income did not go up by 10%. In fact, they overstated by 10%. And this wasn't normally you're going to have a distribution of errors on these things, right? But there was sort of the systemic over-reporting of income across CMBS space. And that strikes me as an example of a governance problem.
Definitely. I think I read about this, and a lot of those loans had gone into conduit deals, right? Yeah. So that is a difficult thing to suss out, right? Especially for an institutional investor that's buying this diversified pool of assets. You need to drill into each of them, and you need to know about the underwriting of each of those loans. I mean, that's where you really need to have that boots on the ground analysis.
So Lamont Gibson has another question, which is, what recommendations would you offer for those of us that are concerned about cultivating the black talent pipeline particularly with respect to both hard and soft skills?
Yes. So I think with the pipeline, we need to start a lot earlier than the company, right? So it has to start early education. And that's probably not something that any of us can address by ourselves or very well, given where we are. But obviously that's the first problem. But once we get past that, I think just getting college students of color just aware of opportunities and getting them connected to that and having the awareness. I just use finance as an example because at least until now, or traditionally, I don't know what it's like for young people today, but when I entered finance, a lot of the people in finance came from families where usually the dad, and I was going to say the parents, but usually the dad was involved in finance. And they talked about it at the dinner table. They kind of heard the lingo. They knew what their dad did. It was kind of interesting to them for that reason, or at least something familiar. There are a lot of people like that. And you could argue that that happens in other professions as well. But I don't think it happens as much in something like medicine, where everybody knows what a doctor is. They've been going to that their whole life. But finance is just this kind of opaque thing. And as we know, most Americans, no matter what their age, don't even know about personal finance, let alone actually working in finance. So there's just this need, I think, to get people when they're young a little bit interested, or at least informed, so they can think about perhaps entering finance. And then once they've actually entered finance, or whatever, I was making this particular to finance, we don't have to. Once they've entered a company, it's really important, I think, to have meaningful mentorship and sponsorship. And I think of those as two different things, right? Because the sponsor is the one who can elevate you in the company if you do well, right? They're the person who will advocate for you and help you to advance. But that sponsor may or may not be your mentor, but you absolutely need a mentor. There's someone you just want to be able to go to just to figure out how to do things, especially when you're young in your career and you don't really know how these things work. And say you're first generation or something, you're probably not going to have anyone else that you can really ask, right? So companies, I think, are trying to formalize those. At Western, we're definitely trying to do that too. But there hasn't been this magic formula where it's like, okay, you just do X, Y, Z. These are the steps and you have a good mentorship program. Those are all still being tested out. And I think that's a big element. And I think, sorry to jump around, but even to backtrack about the recruiting, I think since this person had asked about skills too, that's hard also, right? Because we have to balance between recruiting in non-traditional places maybe, but we also want to ensure that that person has the potential, if they don't already have the skills, but they have the potential to develop those skills. These are really hard questions, right? But we need to attempt at least to try different ways to address them, see what works in order for any of this to move forward.
So I want to amplify a point you made about making people aware of opportunities when they're in high school. And just note, a program I participated in last year was ULI's Urban Plan, which brings a real estate curriculum into high schools. And we did it with Alliance Tech, which is in Lincoln Heights last year. And I participated in that. I had a lot of fun teaching high school students. I hadn't done that before. But what was so striking to me was there were people there who had no idea that they could own a property in their neighborhood, that there's a possibility that they could acquire a 4-unit building in their neighborhood, get a Fannie Mae loan to do it, rent it out, fix it up. They didn't, at that level, they didn't see that opportunity. And so just making those kids aware that this is a thing that they can do, I found a very rewarding thing. So a little bit, we're not doing it this summer for the obvious reason. We're trying to convert it into a COVID or online program right now. But this audience in particular, I would invite anyone who was interested in participating to do so, because again, just planting that seed in the minds of 11th graders, I think is going to be a really important part of this process. So forgive me for the advertisement there for a minute or two. But
I think it's a great example. I wasn't aware of that program. That's fantastic.
So, Bonnie, thank you very much for this very informative conversation. Again, I'm sure our audience really appreciates the clarity. Can you share your slides with the group? Are you all right if we post it on our website?
Let me just get permission and then internally, and then I can do it.
Yeah, that's always the answer. But I didn't see any state secret, son. those slides. And again, very clear delineating things. Our next Lusk Perspective series will be next Thursday, August 20th, where we'll have Neela Richardson, who is with Edward Jones. You may remember Neela, we've had her back when she was the chief economist at Redfin. A real crowd pleaser. People have always enjoyed her presentation. So 11 a.m. next Thursday, August 20th, Neela Richardson. We hope you will join us. Again, Bonnie Wongtrakool, thank you very much for being with us today.
Thanks for having me, Richard.
Okay, take care.
You too.